Welcome to this explainer. Look, if you've spent literally any time looking into trading, you've probably been completely bombarded with that flashy lifestyle marketing, right? You know the ones, the sports cars, the massive mansions. Well, today we are completely cutting through that get-rich-quick hype. We're going to unpack a realistic step-by-step blueprint on how to actually survive and thrive in the Forex market as a beginner. Let's dive right in and lay down the foundation of a true professional.
Okay, so here is the exact roadmap we're going to follow today. First, the $7 trillion market. Second, the anatomy of currency pairs. Third, the mechanics of making money. Fourth, the professional trading setup. Fifth, building your market edge. And finally, number 6, risk management and survival.
All right, let's jump right into Section 1, the $7 trillion market. Before you even think about placing a single trade, we have to talk about the sheer intimidating scale of this arena. I mean, just look at that number, $7 trillion. Forex stands for foreign exchange, and it's the global marketplace where the world's currencies change hands. It is literally the largest financial market in the world, with over $7 trillion passing hands every single day the market is open. To put that into perspective for you, this market is roughly 200 times larger than the New York Stock Exchange. It operates 24 hours a day, 5 days a week. We are talking about a massive, massive ocean of liquidity, and you are about to dip your toes right in.
Moving right along to Section 2, anatomy of currency pairs.
So what are the actual weapons of this market? Well, when you trade Forex, you aren't actually buying a physical asset like a bar of gold or a share of a company. You're trading contracts based on a currency pair. Every single time you look at a chart, you're basically looking at a comparison. Let's break down this somewhat intimidating jargon. If you see UR/USD, the euro on the left is what we call the base currency. The US dollar on the right is the quote currency. Now, the base currency is always equal to exactly 1 unit. So if the UR/USD is trading at 1.09, that simply means 1 euro represents the base value of 1.09 US dollars. Make sense? You are always trading the value of the left against the value of the right.
But here's the thing, not all pairs are created equal. You basically have 3 categories: the majors, the minors, and the exotics. The majors always include the US dollar, which, is the world's reserve currency. Pairs like the euro and the US dollar, or the British pound and the US dollar, offer absolutely the best trading conditions and the highest liquidity. As a beginner, you want to strictly stick to the majors. Now, minors are okay, they cross 2 major currencies without the US dollar. But listen to me carefully here, you must completely avoid the exotics. These pair a major currency with an emerging market currency, like the Mexican peso. They have incredibly erratic price moves, and honestly, they're just a really quick way to lose your capital. Stick to the highly liquid majors.
All right, Section 3, mechanics of making money. So how exactly do we extract profits from these fluctuations? Well, because we're trading contracts and not physical cash, we actually have a double opportunity here. We don't just make money when things go up. If you believe the euro will strengthen against the dollar, you go long. You buy low, hoping to sell high. Pretty standard. But if you think the euro is going to crash, you can go short. You actually sell a contract first, betting on a decline, and if the market does fall, you buy it back at a cheaper price and pocket the difference. So you can make money in a rising market, and you can make money in a falling market. It's fantastic. But how do we actually measure that movement? We use what are called pips, which stands for percentage in point. Think of it kind of like converting millimeters to centimeters. It's really just a unit of measurement. If the euro to US dollar exchange rate moves from 1.2695 to 1.2696, it has moved exactly 1 pip. It's that 4th digit right there after the decimal. As traders, we are capturing our profits in these tiny, incremental, fractional changes in exchange rates.
Let's move to Section 4, the professional trading setup.
The good news is you don't need a massive Wall Street terminal to capture those pips. But you do need a concrete 3-step technical setup that every professional uses. First up, you need a broker. This is the regulated company that holds your money and physically connects you to the market. Second, you need a trading platform, usually something like MetaTrader 4 or 5. You literally log into your broker through this platform just to click the buy or sell buttons. And third, you absolutely need charting software. Don't even look anywhere else. TradingView is the unrivaled champion for market analysis. You do all your deep thinking and chart marking on TradingView, and then you just execute the actual trade over on MetaTrader. Okay, time for some tough love.
Before you deposit a single dime, this blueprint has an absolutely crucial rule. When you sign up for your broker, you'll have the option between a live account and a demo account. You must choose the demo account. Treat this like a video game right now. Lose fake money first while you learn the ropes. If you put real money in before you have a proven strategy, it is practically a mathematical certainty that you're going to lose it. So, master the mechanics with fake money first.
Section 5. Building your market edge.
If you want to build an actual, profitable strategy, you have to face the harsh reality of the power dynamic in Forex. Retail traders, meaning normal people at home, like you and me, we only make up about 5% of the money flow. That's it. The other 95% is institutional smart money. We're talking massive banks, hedge funds, and governments. They have the billions required to actually move the price. We cannot move the market ourselves. So our only job is to spot their footprints and ride their coattails.
And to follow that smart money, you kind of have to unlearn what most beginners do. The vast majority of retail traders rely on basic indicators or super obvious chart patterns like a double bottom. But remember, for every buyer, there has to be a seller. When massive institutions want to buy $100 million of euro, they need immense liquidity. So how do they get it? They intentionally induce retail traders into these obvious patterns, manipulate the price to trigger everyone's stop losses, sweep that liquidity into their own massive accounts, and then send the market flying in the original direction. Wild, right? This is exactly why you have to abandon retail traps and focus purely on institutional logic. Things like supply and demand, order flow, market structure, and liquidity sweeps. You have to think like the 95%, not the 5%.
Finally, Section 6, Risk Management and Survival. This right here is perhaps the ultimate secret to survival, and it's perfectly captured by legendary investor Peter Lynch. He said, "In this business, if you're good, you're right 6 times out of 10. Trading is completely random on a trade-by-trade basis. You do not need a 90% or 100% win rate. Honestly, that doesn't even exist. You just need to be right slightly more often than you are wrong, or make significantly more when you are right than you lose when you are wrong." So let's look at the actual mathematics of survival. Never ever risk more than 1 to 2% of your account on a single trade. Always use a position size calculator to ensure your math is perfect before entering. Always set a hard stop loss to automatically exit the trade if you're wrong so your capital is protected. But here is where the absolute magic happens, the risk-to-reward ratio. If you risk $100 on a trade, your target should be to make $300, a 1-to-3 ratio. If you trade with this math, you can actually lose 60% of your trades. Just let that sink in for a second. Out of 10 trades, you are completely wrong 6 times, losing $600. But on the 4 trades you win, you make $1,200. You literally walk away with a $600 net profit despite being wrong most of the time. That, my friends, is a true market edge.
Real trading is absolutely not about flipping a tiny account into $1 million in a week. It's about slow, steady, consistent, compounded growth. It requires mastering risk, understanding institutional psychology, and being disciplined enough to actually stick to your edge. So, I'm going to leave you with this final, provocative thought. Are you just here chasing a flashy lifestyle? Or are you actually ready to respect the market, put in the time, and master the craft of trading? Because at the end of the day, the market only rewards those who do. Thank you so much for joining me on this explainer, and I'll see you next time.